Hi, everybody. Warren Buffett always says to buy into the S&P 500 ETFs, but is the return slow? Hey, this is Lee, and I'm the retiree trader, and I provide options training, especially to the retirees who fear that they will outlive their savings by helping them to become financially independent so that they do not need to depend on their children. So if Lily can trade, so can you. Now let's find out. The S&P 500 actually comprises of 500 large and mid-cap US stock, and they include Berkshire Hathaway and Apple, Amazon and Facebook, Microsoft and Alphabet, Class A and Class C, JP Morgan, Nvidia, and Tesla. These are the top, okay? But there are others as well, but these are the top, mostly 10 companies. And for the S&P 500, we realize that the annualized return without dividend is 11.56%, and with dividend is 13.91%. And a total capital gain for the last 10 years is actually 198%. So this is pretty good. As mentioned, the top so-called 10 companies actually make up around 30% of the S&P 500. They carry this weight. Therefore, they have really major impact on the market's performance. So 10 companies, the weightage is 30%. This is really heavy. Now let's look at why the Warren Buffett instructed his trustee to invest 90% of his money into the S&P 500 after he dies for his wife. But what if we decide to trade in options instead of buying into the fund? Now let's take a look. This is the trend of S&P for this year. It's trending up, as we can see, where the highs are higher and the lows are higher as well. Just like the past years, the chart is always trending up. So assume you have US $2,000 as a capital. Now, Jan 5th, 2021, when the stock is near the bottom, and you decide to buy 5 stock because 2,000 you cannot buy more than 5 stock. It will cost you 1.8K. However, let's say if you decide to buy a call as option trader with expiry date 21st May, date to expiry is 136 days, strike price 371, and the premium you pay is 1910 because one contract of an option is 100 shares. So you have to multiply by 100. Fast forward to 21st of January, 2021, where the stock price has actually increased to move up to near the resistance. So you decide to sell off your 5 shares. So your immediate profit would be 64.55 or a profit of 3.5%. However, let's say if you had the call position and you decide to close off your call position by selling it off, you would have collected a premium of 26.52. Net of your 1910 premium that you paid up front, your profit would be 742 or 38.8%. Now let's wait, and when comes January 29th, when the stock has retraced back, so you have that money again on your hand and you decide to purchase another 5 shares. You paid 1.8K. But if you decide to enter a buy call position again with date to expiry 140 days, that is 18th of June, with strike price 370, you pay a premium of 2.2K. Now fast forward to Feb 11th, where the stock has actually increased again the price to near the resistance. You decide to sell off your 5 shares again, and your profit would be 103.2, which is 5.6%. Therefore, your profit from the stocks, when you buy, you sell, for these 2 trades would be total of 167.75. But as option seller, when you close the buying call position by selling it out, you would have collected a premium of 2.86 as a profit because your premium collected would be 3,264 net of your 2.2 that you paid upfront. So the profit would be 986. So it's a whopping profit of 43.3%. So total from the past trade and this would be 1.72. You look at the difference, 167 point versus 1.7K. It's a lot of difference. Now let's move again forward. March 5th, where the price retraced back to near the bottom or the support line, you enter another 5 stocks. You buy and pay 1.9. Option, buy call with date to expiry is 133 days or 16th of July. And at strike price 383, you pay a premium of 1.8K. Fast forward to March 16, where the stock has actually moved up again to near the resistance. You decided as a stockholder to sell off your stock of 5 shares. That is, you collect 61.4. That is 3.2%, or a total profit from these 3 trades would be 229.15. But when you decided to close your buy call position, if you were into the option, then your profit would be 720 instead, because your premium collected would be 2.5K net of 1.8K equals to 38.5%. And your total profit would be 2,448. And this is already above your initial capital of $2,000 or your initial investment of 1910 when you first enter a buy call position, the premium that you pay. Now let's move on again. And when March 24th came, when the stock has retraced again to where the support is, you decide to buy 5 stock again, 5 shares of SPY, and you pay 1.9. But if you were in the call option where you have more money now, okay, you can enter another trade. DTE 149 days, date to expiry in August 20th. And you pay 2,068 at strike price 387. But because now your profit is 2,448 plus your initial 2,000, so you have total of 4.4K. But so you can, instead of enter 1 contract, you can actually buy 2 option contract. And you multiply this by 2, you only pay 1.4, which is actually below your total of 4.4K now. So fast forward to April the 19th, where the stock has actually gone up. You decide to sell off your 5 shares, your profit would be 138 or 7.1%. So the profit from owning the shares would have been 367.60 today. But if you had bought call, the total profit for this particular trade where you sell off to close your 2 buy call option position would be 704, which is 17%, which is not a lot. But in total, the profit from option would have been 3.1K, which is a lot, yeah? So let's move on to show you more interesting results here. Come May the 13th, when the stock has retraced to near the support, you decided to buy your 5 shares again because the money that you have so-called earned is not enough to buy you 6 shares at this price. So you pay 2K for it. But if you decided to buy a call position with date to expiry 1 to 7 days, expiring on 17th of September at strike price 410, you buy another 2 call positions and you pay 3.6K, right? So on June the 1st, you decided to close the position when the stock has actually increased to near the resistance again, and your profit for the stock that you own would be 56.95 or 2.3%. That is, total profit would be 414.55 if you sell off your 5 shares. However, for options trader, my profit would be 470, as you can see here, 13%, and then my total profit would be 3.6. June 21st, when the stock retraces back to near the support, again, you buy 5 shares. You pay 2.1. And as an option trader, you buy another call. You pay 5.50 per contract at strike price 420. But because of the money that you have earned so far, you can actually enter 3 call positions instead. Yeah, and you pay, oh, sorry, here it's 116 days. I forgot to change this. My apologies. Yeah, so you pay 4.6K as a premium. Right. Fast forward to July 14th. Your last trade is this amount. Let's say you sell off your 5 stocks. You make an instant profit of 76.9 or 3.7%. Total profit so far from all the trades from stock, buy and sell stock, would be 491.45. But for options, when you close the position by selling off, remember it's 3 trades now, your profit would be 2.7K. For just this contract, when you close, is 59.9. And your total profit from all the trades to date would be 6.4K. This is actually more than 3 times of original start of capital. Now, come July 21st, why I'm showing all this is I want to show you the growth is pretty exponential. Yeah. So on 21st July, 5 stock again, 2.1K, you buy. Call position, you buy again. Now, you pay 15.79 per contract at strike price 434. But now you can buy 5 call options instead because of the premium you've collected so far, the profit you've made. Yeah. And you pay 7.8K. So fast forward to August the 16th, where the stock has actually gone up to near resistance. You decide to sell off your 5 shares and your profit would be 2.9% only, or $62.1. But for your options, when you close them off, the 5 contracts, when you close them off, your profit would be 2.1K or 27.7%, or a whopping profit of 8.5K versus your stock. Your profit is only $553. So you can see from the initial investment, when you although have 2,000, but you invest this amount to buy the 5 stock, you invest this amount to open up a buy call position, the premium that you paid. This is the profit, so-called year to date, that you make from stock, buy and sell. And this would be the profit if you were to enter into a buy call position and you close it by selling it off. So your total ROI for the stock position would be 29.8 or 44.9% for options. But if you are just buying and holding on to the stock, your paper profit would only be 378.2, which is actually 2.2K, less off your initial investment for the stock, which is 1.8. And that would translate to only 20.4%. So it's actually lower because you're not taking profit in between. So again, is investing or buying the fund going to bring you a high return, or would option be a better position? So which is better, buy into the index fund or trade in options? You decide. For me, I prefer options. This is Lily here, and I hope you have actually enjoyed this video. And if you do enjoy, please like, and subscribe to my channel. And I'll see you in the next video. So if Lily can trade, so can you.